start doing some questions from this chapter, the qualitative characteristics of financial information. As we discussed that this is also a theoretical chapter, and the questions which come here, they are conceptual questions, so you don't expect any numerical questions from here. Answers are usually actually not very difficult, but what I would try to do that, of course I will tell you the right answer, but at the same time I would also give explanation for those answers which are not correct. So those options which are wrong options, you should also understand them as well. So number one, let's start with 2.1. Which accounting concept should be considered if the owner of a business takes good from inventory for his own personal use? Now the owner of the business is taking some goods for personal use. It means it is called drawings. And why do we consider it, which accounting concept we should consider it? That it is taken separately. So the answer is D, the business entity concept, because business is a different thing from owner. So if a business is taking goods for personal use, we should consider business entity concept and treat them separately. A, B and C, all three of them are wrong. Why they are wrong? Because A says substance over form concept. Substance over form we use in the situation where we say that the economic reality is more important than the legal form. So we use option A, substance over form, under such transactions where the transaction looks different on the face of it, but actually it is different in reality. So A is not the answer. Accrual concept, of course, we discuss about the time periods, the transactions which belong to which time period. So it is not about any time period. B is also not the answer. C, the going concern concept, it dealt with a going concern concept. It said that a business which does not face any risk in the near future, risk of bankruptcy or closure down. So that is also not the given situation. So A, B and C are the wrong options, and your answer choice is D. Question number 2, it says 2.2, sales revenue should be recognized when goods and services have been supplied, costs are incurred when goods and services have been received. Which accounting concept it governs the above? Of course, it is very clear from the very statement. The answer is C, accrual concept, because accrual is the concept in which it says that transactions are recorded in the period to which they belong, and not when the cash changes hands. So you do not wait for the cash to come in or go out. If any transaction, income or expense has been incurred, it must be recorded. This is your accrual concept. Substance over form, again it does not belong to this situation. Materiality, of course, is not the case here, because we do not know what is the amount of transaction, is it material or not. And not even the duality concept. Number 2.3, which accounting concept states that omitting or misstating this information could influence users of the financial statements? The answer here is materiality concept, because we said that in the very definition of this materiality, that any transaction is considered material which can influence the decision maker's ability to take any decision, which can impact the decision making process. So any number which is significant enough, any number which is big enough and which can influence the decision maker, that is called materiality concept. And I explained you before that materiality is not a static number. For some businesses, $1,000 could be a material number, because for them $1,000 is a significant amount. But for very large businesses, probably $10,000 becomes insignificant, because they are talking about millions, hundreds of millions or billions of dollars. For them, even 10,000, it goes away in the rounding off. So here, whenever we say that which could influence the users of financial statement, we talk about materiality concept. 2.4, according to IASB's conceptual framework for financial reporting, which two of the following are part of faithful representation? Number 1, it is neutral. Number 2, it is relevant. Number 3, it is presented fairly. And number 4, it is free from material error. So your answer choice is C, 1 and 4, that it should be neutral and it should be free from material error. This is faithful representation. Relevant is not faithful representation, and presented fairly is not faithful representation. Faithful representation means that it has to be neutral without any bias and it should be free from material error. 2.5. Which of the following accounting concepts means that similar items should receive a similar accounting treatment? Here the answer is D, consistency. This is we discussed when we were doing the theoretical part of this chapter, that consistency means that you should apply the same accounting principles across different years and across different elements of financial statements. So rule is consistency. Consistency means that choosing or applying the same accounting policies over the same accounting elements or over different periods. Going concern, accruals and substance over form, they do not deal with this similar accounting treatment. 2.6. Listed below are some characteristics of financial information. A. 1. Relevance. 2. Comparability. 3. Faithful representation. 4th. Timeliness. These all 4 are important, but the question says which of these are fundamental characteristics according to IASB's conceptual framework for financial reporting. So we speak about which of them are fundamental characteristics, and answer choice is D, 1 and 3 only, because relevance and faithful representation. If you remember the theory, if you do not, then you should go back and see the slides and listen to it again. It is relevance and it is faithful representation. You just have to remember it, that the information which is presented, it should be relevant and the information should be presented with faithful representation. Let's do 2.7. Which of the following statements about accounting concepts are correct? The accrual concept requires that revenue earned must be matched against the expenditure incurred in earning it. True, this is correct. Number 2, the prudence concept means that understanding of assets and overstating of liabilities is desirable in preparing financial statements. Actually, the prudence concept, it says that assets and liabilities should be estimated at the lowest value. It says they should be estimated, but it does not state that you should understate the asset or overstate the liability. Listen, understating and overstating means that you show it at a lower amount deliberately. We do not understate the asset. We do not show them at a lowest amount. What does it say? Prudence says that if you've got two values, you pick up the lowest one. You do not decrease it, you just pick up the lowest one. But understating means that you decrease it. So we don't decrease it, we just pick up whichever is lowest. So the statement, it looks little bit correct, but it is not actually correct, because the word understate and overstate are not the appropriate words here. So this option number 2 is not correct, it is wrong. Number 3, the reliability concept means that even if information is relevant, if it is very unreliable, it may be misleading to recognize it in the financial statements. So this is correct, because it says that the reliability concept means that even if information is relevant, even if it is relevant, and if it is very unreliable. Unreliable means that you do not have some document for that, but this information, it is relevant information. So it may be misleading to recognize it in the financial statements. So you do not recognize it because it is unreliable. So even though that it is relevant, but it is unreliable, you cannot trust it, you don't have the document. So in that case, you do not recognize it into the financial statements. What you can do, that you should disclose it. Here the word is recognize. So information is relevant to me, so I must show it, I must tell it to the shareholders. But what do? I do not recognize it. What do? I disclose it. So this statement is correct, because it would be misleading to recognize. So you cannot recognize it. So misleading to recognize, this is true. We should not be recognizing it. Number 4, the substance over form convention is that whenever legally possible, the economic substance of a transaction should be reflected in financial statements rather than simply its legal form. We discussed this concept substance over form earlier. Substance over form, I also gave you an example. That substance over form means that economic reality is more important than the legal form. So, which means that sometimes you may show some transactions, or legally you create some evidence for some transactions, but in reality the transactions are different. So we go for the reality, we go for the substance. Substance or reality means the truth, so we go for the truth. So substance over form convention, it means that economic reality is more important than the legal form. So number 4 is also correct. So 1, 3 and 4 are correct, which means our answer is answer choice C. 2.8. Listed above are, it's listed below are some comments on accounting concepts. Number 1, in achieving a balance between concepts, the most important consideration is satisfying as far as possible the economic decision-making needs of users. Yes, it is true that you are making a balance between different accounting concepts, and the purpose of creating that balance is that you want to make sure that the economic decision making, the users of the economic decision making, and the purpose of the users for making economic decision, it should be satisfied. So this is correct. Number 2, materiality means that only items having a physical existence may be recognized as asset. No, it is wrong. Materiality does not talk only about physical assets. You may have things which are non-physical, like intangibles. So 2 is wrong. Number 3, the substance over form convention means that the legal form of a transaction must always be shown in financial statements. No, it is absolutely wrong, because substance over form is opposite of that. So they are just making an opposite statement, because substance over form says that it's not about legal reality, it's about economic form. So number 3 is also wrong. Our only option number 1 is correct, and 1 correct means that our answer is A. Let's do 2.9. Which, if any, of the following statements about accounting concepts and the characteristics of financial information are correct? The concept of substance over form means that the legal form of a transaction must be reflected in financial statement, must be reflected regardless of the economic substance. No, it is absolutely wrong. Number 2, information is not material if its omission or misstatement could influence the economic decisions of users taken on the basis of financial. So it says information is not material if its omission could influence. No, it is wrong, because only material information could influence. So it's not, it says not material. I would say it is material. So option number 2 is also wrong. It may sometimes be necessary to exclude information that is relevant and reliable from financial statements because it is too difficult for some users to understand. No, it is also wrong, because we said that we prepare financial statements with this understanding that they should be understandable by the people with reasonable knowledge of accounting and finance. But at the same time, it does not mean that you ignore the complex matters. So even if there are some complex matters, they should be included if they are relevant or if they are reliable. So it means that option number 3 is also wrong. 1, 2 and 3, all 3 of them are wrong. Your answer is option number D. None of these statements are correct. 2.10. The ISB's conceptual framework for financial reporting gives 4 enhancing qualitative characteristics. What are these 4 characteristics? Now, when I was, it is actually present in your slides as well. I explained it, and you should go back. You have to remember option is D. There is, I wouldn't go for any logic for that. It is something which you just have to remember. That D is the option which says comparability, timeliness, understandability and verifiability. These are the 4 enhancing characteristics. So you just have to remember option number D. I cannot give you reason for A, B, C why they are not, because they are just not. You just have to remember. 2.11. Which one of the following is not a qualitative characteristic of financial information according to the conceptual framework for financial reporting? Which one of the following is not qualitative? D is not qualitative. A, B and C are qualitative. D is not qualitative because D is accrual. Accrual is not a qualitative characteristic. Accrual is something which was like you have one underlying. Okay, so D is the answer. Accrual is not a qualitative characteristic. Again, you have to remember our third slide from this chapter. We said that going concern was the underlying assumption, and then IAS 1, it requires you to prepare financial statements on accrual basis, but it was not a qualitative characteristic. We had only two qualitative characteristics there, which was faithful representation and relevance. Accrual is not a qualitative characteristic. And timeliness was the enhancer. So you should understand A, which is going concern, it was your underlying assumption. Relevance was your qualitative characteristic. Timeliness was enhancing qualitative characteristic, and accrual is not there. So answer choice is D.